Again, thank you all for coming today, and I'll turn it over to Sara.
Hi, I'm Sara Calabrese. So previous to working with the law offices of David L. Carrier, I was a Department of Health and Human Services caseworker. And 5 of those years, I was 14 years at DHS, and 5 of those years I worked with long-term care Medicaid as my specialty load. And so I do have a background in this. And we've been able to, this is going to be our 4th boot camp. And we're hoping just to bring a little insight into how applications are determined, what things you can do to help your residents to basically become eligible for Medicaid, stay on Medicaid so that you get paid. So these boot camps are geared towards that. And your insight today, well, in the past, asking for more information on PPAs, as well as us thinking this is a very valuable boot camp to have because you deal with PPAs all the time. PPAs, sorry, just to move back just a little bit, PPAs are patient pay amounts. And we think that it's going to be valuable for you for a few different reasons. One, I know that when you are looking at a potential resident coming in, one of their main questions is how much is it going to cost me? And so we're hoping that this will give you a better idea. You can ease their mind, give them an idea of how much that it is going to cost them once they become Medicaid eligible. You know, there's a big difference between Medicaid eligibility and what they have to pay for patient pay and the full cost. Secondly, when they actually do become eligible and they get that letter as to how much is that, you know, how much their patient pay is, sometimes they wonder why it is what it is. And they come to you for those questions. And so hopefully, again, this will help you maybe be able to answer some of those questions better, just having the insight as to what it means and why it may be what it is. And then thirdly, when you get those letters too, and they come to you, you might also have a better idea of it not being accurate. So caseworkers, like anybody else, they make mistakes. They have a tremendous amount of paperwork that comes to them, and it's all electronic, and they easily miss things like putting in health insurance premiums or something like that. And if you don't know to look for that, then you don't know to ask them to correct it. And then and if it's not corrected, then the resident is paying more than he should or she should. So those reasons we thought it would be really helpful. Patient pays, there's a lot of different dynamics to it. And there's a lot to it. It's not just a straightforward answer. So I'm gonna kind of go through all the different areas of PPA and what they mean. And I'm gonna set it up like the way I set it up in general, because we do a lot of calculating PPAs so that we can give our clients an idea of how much they have to pay. And then we actually do have them pay you during that Medicaid process, what we anticipate is going to be the payment. That way you get the payment right away in anticipation of Medicaid approval. So I'm gonna just take it step by step and work through it. And we're gonna send out this PowerPoint afterwards. And we also have a great spreadsheet that we're gonna send out to you as well. And when I get to that, I'll show you what it is and how you can use it. So those will be coming to you after the presentation. We are recording this as well. So it'll be on our website in probably 48 hours. Within 48 hours, the presentation will be on the website, as well as we will email out the PowerPoint and the spreadsheet. So I'm going to go dark while I go through this presentation. If you have any questions, just put it in the question and answer, and we'd love to answer them. David is going to join us, as well as Ardene Martin. Many of you may know Ardene Martin as our PME specialist. Now she's an absolute Wonder Woman at Medicaid eligibility as well. So I know she's had a background in it, but many of you know her from that. So she's joined our team and she'll be on here for question and answers as well. So go ahead and add those to the question and answer down in the bottom on your toolbar, and not the chat. We'll be answering it from the question and answer. So like if you've been on any of the other boot camps, I really like to let you know where you can find all of this information in policy. So everything that DHS does is based in policy. And if you have where you can look and kind of how to interpret it, I think that knowledge is very helpful, especially when you're trying to sift through why DHS might be doing what they're doing. So the patient pay amount policy is found in BEM 546, post eligibility patient pay amounts. So the patient pay, just to go back a little bit, patient pay is the amount of money that a resident is going to have to pay towards their monthly nursing home bill. And this is for somebody who is admitted or expected to be admitted for 30 days or more. Those individuals are assigned a patient pay amount. If you have somebody who is already active Medicaid and they weren't admitted for 30 days or more, or are not expected to be admitted for 30 days, maybe they're just there, you know they're going to be there for only a week or two. If they came in on active Medicaid, you would probably see that they came in under a spend down. And so for those individuals, they're not going to get the full Medicaid. If they're not there 30 days or expected to be there 30 days, it'll stay that spend down status. But when you have those that come in and you're expecting that they'll be there 30 days or more, a patient pay comes into, is calculated out and sent to the client. And then you'll also see that in CHAMPS. So patient pay amounts are calculated using gross countable income. And then you can subtract the following things. So once you calculate what their gross countable income, from that, you would subtract health insurance premiums. If they have a guardian or a conservator, you can subtract those guardianship and conservator expenses. There's a patient allowance that you can subtract out, and we'll go over what those are. There's a family allowance for those who are married and have dependents. There's a children's allowance for those who are single and have minor children living with them. And then there's the community spousal income allowance. And that's for somebody who is married. We would be looking at having a deduction for that. And then there's also a program, the home maintenance disregard, that is an option. And that'll also allow a larger amount to be deducted from the gross income, which calculates out to what the patient pay is. I'm going to take each of these individually. So from gross income, you would subtract out any health insurance premiums that they pay. So that includes Medicare premiums paid out of the Social Security, all of them, B, C, D, any of those health insurance premiums can be deducted from gross income. Any supplemental policies that they pay for that has a monthly premium. Dental, vision, those types of things can all be deducted. So you want them to be able to have a smaller patient pay amount so they have the money available to be able to pay those health insurance premiums. So it's adjusted based on what they pay. Now, some policies may pay out quarterly. The payment plan may be annually. it's okay. When you calculate out patient pay amount, you would actually divide that by however many months it is. So if it's quarterly, divide it by 3. If it's annual, divide it by 12. And then use that as verification. And use those numbers in your calculation. So with all of these, you actually have to send verification. So the most common thing you could use, actually it's not the most common thing, the most helpful thing, let's say that, is a monthly bill. So there are some health premium statements that come out monthly. So that's the best because DHS always wants current verification. So if they have that bill, that's perfect. It shows who the insurance is for. It shows the current monthly amount that they owe, and you'll want to send that. Now, another thing that more commonly happens is an insurance company may send a statement at the beginning of a premium change. So, 8 months ago, when the premium changed, they sent a statement stating that the premium was going to be $37 a month. And then often they do an auto deduct from their bank account. So if your resident has that original premium statement, you could use that as long as it shows all of the information, such as who's insured, the premium amount, when it was effective. And then on a current bank statement, let's just say it's from Priority Health. If the current bank statement shows that Priority Health is being paid at $37 a month, and that letter from 8 months ago says that it's Priority Health at $37 a month, the two together should be sufficient to show that $37 a month is the current premium. And you can do that with any of these. The third option is you call the company and you just request a current verification of it. So the next expense that we can take out of a patient pay to lower it is if they have a court-ordered guardian or conservator. If they do, on the first page of the Medicaid application, the DHS 4574, it has a little section in there if you have a court-ordered guardian or conservator. So you would just mark yes, put that person's information, and on that, it asks if there are expenses. And if you mark yes, they will provide, at this point, an $83 deduction per month. In order to verify that, you just have to send them the current court-ordered guardianship or conservatorship paperwork. Once they get that, then they should apply that $83 per month deduction. The third one is patient allowance. So many of you are probably familiar with, overall, our residents are able to keep $60 per month. So that $60 is intended for them to be able to have a little bit of money to buy any personal items that they want, if they want to play bingo, if they want to, get their hair done, just any of those little extras. That's the amount they get to keep. That's the one that's most widely known. And $60 is applied for those who are there on the first day of the month. They're admitted inpatient on the first day of the month and expected to be admitted for 30 days. So that they'll get the $60. There is a little deviation from that for those who are on Medicaid or first applying for Medicaid, and the admission is not on the first, it's in the middle of the month. So basically the second of the month or after. That first month that they are admitted for that partial month, they actually don't get a $60 deduction, they get a $391 deduction for that first partial month. And then for that next month, they're in the facility on the first of the month, so it reverts back to $60. And you'll really see that mostly when it's a new application. So you've got somebody who applied, let's just say today on the, or admitted today on the 20th, and we're looking for October eligibility. In this situation, their patient pay would be $391 patient allowance rather than the $60. And then next month, it'll go up on this that next month. So when you look at those notices, it's kind of confusing that it'll say effective October 1st, the patient pay is a lower amount. And then November 1st ongoing, it'll be a larger amount. So this is a flag to you to know. I mean, that's an easy question to answer, especially if the difference is $391. Actually, it would be $331 would actually be the difference. The third situation for patient allowance is $90. Those are for individuals who receive veteran benefits. So when somebody comes to you, you'll want to make sure that they know they have to contact VA and let them know that they are in an institution. VA then does paperwork to possibly change their benefit to $90. So eventually the thought is that their benefit will go down to $90 and they basically just keep the entire thing. But they do get that allowance right away if there are veteran benefits. So it's not 60, it's 90. Another allowance that you are could potentially be eligible for, your residents, is the family allowance, and it's for those who are married. So if you have family members that meet this definition, your family members would live with a community spouse and be either of yours married or unmarried children under age 21. They can also be married or unmarried children age 21 or over if you claim them as a dependent on either of your federal tax return. It also could be a sibling or a parent if they're claimed as a dependent on either of your federal tax return. So in this situation, you would first calculate the basic allowance for each dependent that you have. And that basic allowance right now is $2,155. You would subtract out their accountable income and divide it by 3. So when I go through this, there's certain things, I mean, it's very intentional. Basic allowance is very intentional. Countable income is very intentional. So when you look in policy, you would want to look for those terms and determine what is countable income. I didn't want to, go off and into that type of stuff and muddy the waters. But you can go ahead. Income is in 500, whether it's earned income or unearned income. You can look up what's countable, and you could use that. And then the basic allowance is found in BEM 546 in this post eligibility PPA policy. So you would calculate it that way, and then the family allowance is the sum of each dependent's basic allowances. So if you have more than one dependent, if you have 2, you would do that calculation for both, add it together, and that would be what would be deducted from the patient pay. Another allowance is a children's allowance for those who are married and living with minor children. So children are those unmarried and under the age of 18. And they don't receive FIP, which is Family Independence Program. That's a cash assistance program through DHHS for those who have minor children. So they can't receive that FIP assistance or SSI. And this one is just a little confusing. There's a few different things you have to look at when you're looking at calculating out this children's allowance. So there in policy, there's a chart, and I'll show you where to find these charts. But first you have to determine what shelter area that they live in. So there's 6 total shelter areas, and in the policy RFT 200, you'll find all 6, and then you would just find what county they live in and determine which shelter area they're in. So for example, Kent County is in shelter area 5. Second, you would want to calculate out their income. So you would determine what the net income is. And the net income is 80% of their countable income. So it could be child support, it could be a job, it could be anything like that. Again, net income and countable income are intentional. So there are specific things in policy that tell you what countable income is in those situations. So net income is 80% of their countable income plus any countable unearned income. So first you find the shelter area, second you determine that income, and then third, you would subtract the net income from the child's protected income limit. And that is in RFT 240, which is this right here. So say it's a mom with 3 children who live with her. So that would be a group size of 4. If you go to shelter area 5, they would get a $578 deduction for that child's allowance, that children's allowance. And it would calculate out based on that. In order to find these, you would go into the policy manual, and it's right under, right on the bottom, tables, RFT. So it's reference tables. That's what RFT stands for. So that's where you would find those. So depending on whatever the situation of your resident is, that's how it's calculated out. And then there's the community spousal allowance. This is the one many of us know about as well for those who are married. So this can be fairly complicated. And this is what we're going to send you out. We use a spreadsheet that helps us calculate this out. It's tremendously helpful, and we want to share that with you as well. So as we go through it, I'll show it to you, but know that it's going to come out to you as well through email. So in terms of the community spousal allowance, the first thing you want to determine is what their shelter expense is. So below, these are some of the things that you would use towards that shelter allowance. And it's for those couples' primary residence. It has to be their primary residence. So you would be able to, if they have a land contract or a mortgage, and this includes any principal and interest, you could use that towards it. Home equity line of credit or any type of second mortgage. If they rent, you can use that monthly rent. If they pay property taxes, you would want to supply them with the most recent 2 property taxes. So added together, that's a year's worth. All of these, PPA is a monthly amount. So you would break that annual amount down into a monthly amount. So whatever the sum of the last 2 property taxes are, you would divide it by 12, and that's the amount you would use in this as part of the shelter expense. Any type of assessments, often when people live in condo associations or any type of development, sometimes they'll have special assessments. Those can be used. Condo fees can be used. Sometimes there's an extra maintenance charge as well for those condos or associations that can be used. Homeowners insurance, usually homeowner insurance is an annual amount. So again, you would just take that annual amount and divide it by 12. And same thing with renters insurance. And there's also an extra amount that can be applied towards the shelter expense for heat and utilities. So this is if they have the obligation to pay heat and utilities. So when they own their home, of course, they do have that obligation. So just send in a gas bill. It doesn't have to be all of their expenses. A gas bill is sufficient to be able to get this allowance for the heat and utility. If they rent, if the lease contract says they have an obligation for heat and utilities, then yes, definitely send in a gas bill as well. If it doesn't, then they just won't get this standard. So heat and utility, it's not based on amount that's paid. it is based on a standard amount, a monthly allowance of $559. So it doesn't matter if they pay $20 in heat, it doesn't matter if they pay $300 in heat. They're going to get that monthly standard of $559. When you send in, you have to submit verification of all of this. DHS wants current verification of all of it. And so when you send in something, you want to make sure it has, and this is for all verifications, want to make sure it includes what type of expense it is. So in this example, it's an electric bill, and whose name and who's obligated to pay. So this bill says service for, and then it would have your resident's name and then their primary resident address. It also should show the amount that's owed. Again, it doesn't, depending on like this, an energy bill, you're just going to get the standard $559. But if it's a mortgage, they want to know how much the mortgage amount is because they're going to use that. If it's property taxes, you want to have what amounts owed for the most recent two. And then make sure it shows the date so that they know it's current. Obviously, this one's not, it's from 2013, but you want to show that it is a current bill. If you use homeowners, when you send in verification of homeowners insurance, you want to make sure it has that period, premium period on it. It's from August 2021 to August 2022 and what that premium amount is. So we come across quite a bit when, they've sold their house and they've moved into assisted living. Unfortunately, home for the aged or adult foster care home is not considered a primary or principal residence. So although they pay a large amount of money, probably way more than they would if they owed their home, unfortunately, that is not considered a primary residence. So they are not able to get the shelter expenses towards the community spousal allowance. The way that I find what the category is to ensure that whatever assisted living they're in or adult foster care, to ensure that they're actually licensed that way, is I go to the LARA website and do a search for adult foster care homes and homes for the aged. So in this example, I did a search for Covenant. And so down below, it shows Covenant Village of Great Lakes. It is a home for the aged. So anybody that does live there, if my residents, if they live there, unfortunately, you cannot use that as a shelter expense. So this is the spreadsheet that we'll be sending out to you. And on the top of it, it is outlined, as in policy. So step one is shelter expenses. So in this situation, they had a gas bill and they have a mortgage, and mortgage includes property taxes and homeowners insurance. So we're not going to send property taxes or homeowners insurance because that's included in the mortgage. So then it figures out what that shelter expense is. And these next few things, so the excess shelter allowance, the total allowance, this is all wording and policy. So when you go through it, it does go step by step. And these standards change from time to time. So when you look up at the electric, it actually just changed to $559 effective October 1st of 2021. Previous to that, in January, from January to September, it was $537. So you want to use whatever standard there is at that time and look for that. And I'll show you next where you can find these changes. So the shelter standard can change. And same thing with that basic allowance that we just talked about. It used to be the $2,155. And As of July, it changed to $2,177.50. So this spreadsheet does all these calculations for you. So really what you need to do is to figure out the community spousal income. So this community, you determine what type of income the community spouse has. So in this situation, they have Social Security. And the amount you're going to put in here is the gross Social Security minus any healthcare premiums. It could be Medicare, it could be possibly Priority Health. You know, if they pay privately for health, then you can just subtract whatever it is out of this gross and put that amount in there. And then it calculates out the total allowance is a standard, and then it deducts out the income, leaving you with, at the very bottom, what their community spousal allowance is. So in this scenario, it's $1,312.25. And we'll go down further into how to calculate the next step, which is the PPA, based on knowing the community spousal allowance is this amount. You do want to make sure, just to be the most accurate, that you are updating those standards as they come out. So here's where you can find it. One, you can go back in policy in 546 and it'll have those updated amounts, but you probably don't want to do that every time. A good way to know, once a month I go in and I check these bulletins. So when you go to the policy manual, you'll go into summary of manual updates or bulletins. And these are what changes have taken effect in policy. And in October, when I went in here, you know, the first two didn't have really anything to do with Medicaid, or especially the Medicaid that we do. But I noticed that there's a post-eligibility patient pay heat and utility standard change. So I will go into there, and then you'll see that effective October 1st, the heat and utility standard changed to $559 per month. So then I would, you would want to make sure that you go into your spreadsheet and update that so that you have the most recent information. So the last allowance or amount that you can deduct out of gross income is the possibility of having the home maintenance disregard. So the home maintenance disregard, it is an amount that comes off the patient pay for those patients who are in long-term care for less than 6 months. So they have to be expected to go home within 6 months. And the reason for this is if they're expected to go home, it does give them some extra money to be able to pay for those expenses. Because as we talked about, in the majority of cases, they only get to keep $60 a month, and that's not enough to pay their rent, to pay their mortgage. It's definitely not probably going to pay all of their expenses, but at least it will help more than $60. And when you have this disregard, it provides a deduction of $794. You can qualify for this disregard if you are in a long-term care facility for less than 6 months, active full Medicaid coverage, and you are responsible to pay a PPA. How you get, you do actually almost have to apply for this. You have to submit, or an authorized individual or the patient, if they authorize you, you can do it. A written or verbal request made to DHHS requesting this home maintenance disregard. So just a simple letter on your letterhead requesting the home maintenance disregard. It has to include, the request has to include a physician statement stating that the patient will return home within, is expected to return home in 6 months or less from the date of admission. And then also you'll want to send verification of those housing expenses. So if they have a mortgage, send them the current mortgage bill showing that, yes, it's in their name and that is their house and they are paying that obligation. You don't have to send all of their bills. You don't have to send, water, cable, telephone, all of that. Just a mortgage statement and maybe a gas bill is sufficient. Just something, because it's not based on amount. It's based on a standard of $794. So submit those 3 things and they would be eligible for the home maintenance disregard. Unless they are in foreclosure, eviction, or bankruptcy proceedings, and the home is not occupied by a community spouse or children eligible for the family allowance income deduction. So if the community spouse is still living there and it isn't foreclosure, eviction, or bankruptcy, they should be able to still get the home maintenance disregard. But if there is nobody living there that meets those qualifications, then they would not be eligible. The other caveat to this is that is a lifetime maximum of 6 months. So they have to verify that they are going to be admitted 6 months or less. And however many months, say they go home after 2 months. They've used 2 months of their 6 months. If they go back again later down the road, and again, they're just a short-term stay, then they've got 4 months left to use. And then once they reach all 6 months, then they can never get it again. There's a 6-month maximum, lifetime maximum. So here's an example of how we actually calculate the patient pay. So here's single Sally. So she's got income of $1,500 a month in Social Security. She's got a GM pension of $429. She pays a Medicare premium of $148.50. And she also pays for a supplemental policy of Priority Health of $37. And her patient allowance is $60. So when you calculate out the PPA, and this will be part of that spreadsheet as well. We're going to actually send 2 out, one a more simplified version of the PPA, and then one that shows the community spousal allowance. But you take her Social Security income, her pension, add those 2 together, and those are gross amounts. You subtract out her Medicare cost, subtract out her health insurance premium, and subtract out the $60, leaving an estimated PPA of $1,683. And then when we go to trying to determine the community spousal allowance, we've got married Martha. She has a home. She has a mortgage of $1,039. There's escrow in it, so we're not going to also deduct property taxes and insurance, but we are going to be able to give her the heat standard of $559. So her husband, Bert, has Social Security income of, actually, I'm sorry, I did this wrong. So actually in this chart, the mortgage is $729, but it's not escrowed. And she actually does have property taxes and homeowners insurance. So the property taxes are $3,000 a month or a year, I'm sorry. And you divide it by 12 to come up with a monthly amount. So when you do this calculation, you'll divide it by 12. So you use $250 per month for the property taxes, and the homeowners is $850 a year. So again, divide it by 12 months to come out to a monthly amount of $70.83 per month. And then you would also include the mortgage. And then you've got all those standards that are automatically calculated. When you use a spreadsheet, you'll just update those things that are in green. And Bert's got Social Security income, and he pays Medicare Part B of $148.50. And he also has a pension of $349. So when you're looking at Bert's income, you're going to do the gross of $1,750, subtract out the Medicare Part B to come out with what his net Social Security is. And then you're going to use what his pension is. Those two will be added together. And then the spreadsheet does these calculations for you. Bert is allowed to keep $1,182.58. So the next thing we want to do is calculate out what Martha's, what her PPA is going to be. So Martha's got Social Security income of $1,500. We're going to deduct out her Medicare cost of $148.50, and she has a patient allowance of $60. So we're also going to deduct out that $1,182 in spousal allowance, leaving a patient pay of $108. So Bert gets to keep the majority of her income. So what can't be deducted when you're looking at patient pay? So there's a few things that you can't deduct. A common one is federal or state income taxes. So often we'll find Social Security might have those extra deductions of taxes. And unfortunately, we can't take those off the table. We are not accountants, we're not CPAs. So, we do ask them to talk to a professional, and maybe it's okay for them to stop those deductions. Another thing we can't deduct are garnishments, unless it's from the same source. So if Social Security is garnishing because of an overpayment, that actually is something that can be deducted. But let's say they were overpaid in VA and VA garnished Social Security. Unfortunately, that is a situation where those garnishments are not going to be taken into consideration. Alimony, child support, union dues, those are some of the other more common things that we see. And unfortunately, those can't be taken into consideration when you're looking at the patient pay amount. So when they do have these, this will often probably be a question to you. They'll come and they'll say, I don't even have enough money to pay this patient pay. And you look at the bank statement and yep, they do not have enough money going into their bank account to pay for it. Unfortunately, unless they can get those deductions changed, they will never have enough money to pay for their patient pay amount. Sometimes you'll see somebody who comes in and they have income, but they have a zero patient pay. So two common scenarios are somebody who's active HMP Medicaid, which is a Healthy Michigan plan. And those are individuals ages 19 to 64. Those individuals with Healthy Michigan plan, they have a zero PPA despite the income that they receive. Also, those who are active social SSI, they will always have a zero PPA as well. So just to put a little more complication into all of this, once a patient pay has been determined, the timing of changes is critical. So when you newly apply for Medicaid, whatever is determined is effective immediately. If once that patient pay is determined and you're sent notice of it, if there is a change, it falls under two categories. And if it's a positive change, so say that to the resident, say the patient pay decreased, that's a positive for the resident because they get to keep more money. Then that's called an adequate notice. And that change is effective at the same time the notice is sent. So if it says, on October 20th, DHS determines that the patient pay can be lowered, they'll send a notice. Effective October 1st, that deduction or that lower amount is effective immediately. And then there's other situations where if there's a negative change, they have to give timely notice, which provides a resident at least 12 days notice before the change can take effect. So that's those when you see on October 20th, the patient pay is going to increase. That's a negative action towards the resident. That's why the effect is not actually going to take, or the change isn't going to take effect until December, because they have to give the client 12 days notice. And if the change was done today on October 20th, there's not 12 days between October 20th and October 31st. So they can't make that change effective for the next month. It won't be effective in November. It won't actually change until December. I've got David here now. He is here for question and answer, but we just see the impact. In the past, when I worked for DHS, talking with you in the nursing homes, I know you got a lot of questions about patient pays. I know that, we anticipate, and we do a very good job at anticipating what the patient pay amount is. And I also see those changes from, when we get a notice of a PPA, and I look at what we anticipate, and if it's different, I have the tools to determine why it's different. And then I can go back to them and just ask, did you add in the health insurance premium? And it's very easy for them to forget those types of things. They have a lot of paperwork, they have a lot on their plate, and it's easy to. So this will just hopefully give you the tools to be able to help your residents gain the accurate amount that they have to pay, and then that's the amount that you get paid as well. And Ardene's with us as well. Hi, Ardene. You're on mute.
Hi, everyone.
Any questions at this point? Go ahead and add it to the question and answer.
You see the open question, Sara?
Yep. So the first question is, shouldn't they get a 0 PPA for their first month when they have been home for the first few days of the month? They have paid their home's expenses by now. No, it's not a 0 PPA.
One of the things when we're trying to figure out what should be the first month of eligibility for a client, by the time you get, because if they're eligible for Medicaid for any day during the month, they owe the entire patient pay amount. So if you get down to, October 29th and you say, well, I'll pick up the last 2 days of the month, it doesn't work like that because they owe the entire patient pay amount. So when you get to the last week of the month, last couple of weeks, then you really have to take a hard look. And this is why it's so good that we can calculate patient pay amount. We can determine, does it make sense to apply for eligibility for this month when the patient pay amount is going to exceed the private pay rate for the last week or something like that. That's something that comes up, I'd say, pretty often. People wonder about that.
Mm-hmm. Yeah, there's a couple other scenarios too where, yes, it might be 0 PPA. So say they actually do have full Medicaid and they come into the nursing home. Applying a PPA is a negative action. So they have to give that timely notice, which then pushes the effective date of a patient pay amount out a month or two. So in that scenario, it's possible. But if they come in under spend down, it's not a negative action. They get adequate notice and that PPA is effective immediately. Although that PPA is calculated based on the $391 patient allowance rather than that $60 patient allowance for that first partial month.
I think one of the most startling things for your residents, for applicants, is the idea everyone's got in their mind, I get to keep the homestead, I get to keep the homestead. And what they don't realize is with the patient pay amount, you don't have any money to pay, and they get angry, get a little heated sometimes. So what do you mean I keep the house? I can't keep the money to pay taxes. I can't keep the money to pay insurance. I can't keep utilities. I can't maintain the property. And the answer is, you're right. You really, except for that, the 6 months, 794 that I was talking about, if it's likely that you'll go home, you're anticipated to go home in the next 6 months. Except for that, you're right. I mean, kind of go ask the kids for the money. Too bad, so sad. But that is the reality. And it may not make a lot of sense. We let you keep the house, but you can't have any money, so it doesn't go back to taxes. I mean, this past spring, we still have a dozen houses going back because the kids will pay. Lots of times the kids will pay for a year or two, but generally by year 3, they're tired of paying for mom and dad's house. Then you see it go back. That just happens. It's just a shame.
So the next question is the intent to contribute form for spouses. What's the impact to the patient pay based off the boxes that are checked? Good question. I actually meant to add that into this. I apologize. So great question. The intent to contribute form, that is one that comes when there's community spousal allowance. Basically, that tells DHS, the resident, how much income they want of their income to go to their spouse. There's a few different boxes that they can check. One, yes, I want 100% of the community spousal allowance to go to my spouse. That's always going to be the default. So if you don't send that back, they're going to default to the fact that they are going to give the spouse the maximum community spousal allowance. And then there's a couple other boxes that I only want a partial amount, and you can determine what amount you want. Or no, I don't want any of my income to go to my spouse. Granted, you don't get to keep it. I mean, it's just going to become part of the patient pay, but there are circumstances where, you know, the spouses are not in the picture and may not want that to go to them. There's also another situation where income that goes to that community spousal allowance is considered income for DHS. So let's say the community spouse is also on Medicaid, and based on his or her income, they're eligible for full Medicaid. And then adding that community spousal allowance on top of it puts them over to where they don't get full Medicaid anymore, and now they're a spend down. Sometimes they're active food assistance, those types of things. So that extra income is actually a detriment to them.
Sarah, what influence would that have, paying a patient pay amount to someone who might be on PACE or a waiver?
Yeah, and that's another situation as well. PACE or waiver, there is an income limit. So if the spouse is, but if they're on PACE or waiver, then that income could put them over, but then there wouldn't be a community spousal allowance because they're no longer a community spouse if they're on PACE or waiver. So there's a lot of different dynamics when you look at every situation. And yeah, this is why we bring you this, as well as, you know, the benefit that we can provide your residents, especially for some of those more complicated cases.
I like the last question. How do clients receive the $90 VA allowance? The client has to contact VA or Health and Human Services. Here's the thing with that, and there isn't a $90 allowance. That's not really how it works. You get the disability pension, the improved disability pension, or the improved death pension, right? As the surviving spouse, or if you're the vet, you get the improved disability pension. What happens is, if you're receiving VA benefits, you get no patient allowance. That's just cut. And at the same time, the VA, the VA money doesn't count as income. Okay, so there may be months of overlap where you're on Medicaid and you're getting your VA pension, the disability pension, the death pension. Money doesn't count as income to the recipient. But once you're on Medicaid, then the VA cuts your pension to $90 a month. So it's not like you're saying, hey, give me the $90 a month. It's like, no, you got to be eligible for the pension, and then we're going to cut it to 90. And DHS on the HHS on the other side says, and we're not giving you the patient allowance.
They give a $90 patient allowance in those situations. Yep. Yeah, and they'll know because you're sending them verification of the VA. And so that VA income is part of, they do use that VA income, whatever it is, say it's $1,700 a month. They're going to use that as part of the PPA calculation until it changes down to $90. but they are going to get a $90 allowance rather than the $60 allowance. If they, even if it's $1,700, they're going to get that $90 allowance right away, rather than the $60. And then once VA actually changes them to that $90, they reduce their benefit to $90. They just basically get to keep the whole $90. So you actually want to do both. DHS should already know that they're getting VA. But on the other hand, there could be consequences with VA if they don't report being institutionalized. And then that could be a situation where they recoup money. So you definitely want to contact VA as well.
There's a question in chat as well, Sarah.
Okay. So another question, any insight with getting PPA corrected during this PHE? Not sure what PHE is.
I'm sure I don't know. Oh,
So if the
public
patient,
health emergency.
yeah, public emergency, yes. So if there is a correction needed to patient pay, they should be correcting it, especially if it's in the benefit of the client. I don't think that they're changing patient pays in a way right now. I'm not 100% sure on that, but I don't believe that they are, and they're definitely not closing cases. If it's a positive, they should be changing the patient pay based on any type of increase. Ardene, do you have any more insight into that?
Yeah, you're right. If it's to the benefit of the client, they are supposed to be correcting them. But if there's a negative action, we cannot apply it at this point in time until directed from the feds, basically. So it's going to be a while.
We have a resident that receives no income at all due to the IRS having a lien on her Social Security. Shouldn't she at least be allowed her $60 so she can have some money for spending? Well,
No.
yeah.
What you
No.
think should happen isn't always what does happen, unfortunately. So like we talked about those liens, the garnishments, the IRS is a different source. The overpayment or the garnishment is a different source from where the income is coming out of. And when it's a different source, it is not something that's taken into consideration. So she does not even get the $60, unfortunately. Now, if the garnishment was from the same source, so say Social Security was, there was an overpayment in Social Security and they garnished from the Social Security, it's the same source. And that is taken into consideration, but not when the sources are different.
Now, here's a question though. Would the facility get the amount that was patient pay amount with Medicaid pay? Or would they reduce the patient pay amount to what she's actually getting? I don't think they will. I think the facility's over barrel at that point, because that debt just continues on. And at that point, you have the other remedies that you have to collect unpaid patient pay amount. You know, when they first did the financial abuse of the elderly legislation, I don't know, probably 10, 12 years ago, the first defendants were all those kids who weren't paying the patient pay amount. And you may recall the newspaper articles about, because they tracked the spending down. It turns out the kids were using mom's Social Security, everything from drugs to the casino to, you know, they didn't publish when they were using it for the Christian school tuition, you know, but you heard a lot of stories about, you know, misappropriation of those funds. But at that point, as the facility, you have the ability to go and sue them if they still have a house, a homestead. You know, Medicaid can't take the homestead, but you can. You know, if they owe you money, you have the right to pay judgment and to satisfy that judgment from any other resources that they may have. And of course, if they transfer, that's the reason they're not paying the investment, then, you know, fraudulent transfer lets you go after the kids they gave the house, to whom they gave the house. So you have remedies there. Can the patient pay amount be garnished? Not exactly. I mean, the way Medicaid works is Medicaid's not going to garnish. Medicaid just says we're not paying. You know, that's all the enforcement Medicaid has. But as an institution, as a facility, you have much greater enforcement mechanisms than Medicaid does. Now, that can wind up being very, very detrimental to the client. So let's say Let's say they failed to pay the patient pay amount and they owe the facility $6,000 and an additional $2,000 every month. And, in Michigan, the homestead can be worth $603,000. So let's say they have a house on the lake that's exempt. The kids are paying the taxes on it because they want to keep the house, or maybe they're using the income to pay the taxes, utilities, upkeep, that kind of thing. Well, even though it's only $20,000 or whatever, you can still sue to collect that. You can sue. They owe you the debt. They didn't pay the patient pay amount. That is their obligation. You can get a judgment against the client and satisfy it from that exempt homestead. The homestead is only protected to the extent it's protected at all. And I think that's a really very poor way of talking about how the house is maintained. It's not protected. It's just that the state of Michigan doesn't come after it. You can go after it all day long. And think about the bind that puts the family in, because they've got the $603,000 house, which is the maximum, right? They owe you $20,000. You've got a judgment. You can execute on that judgment and force a sale of the house. I wonder if the kids would come up with the money at that point. I wonder if they make sure that they paid the patient pay amount, because that patient pay amount for you, right? For you is the difference between, we're floating the boat here. We've got enough to actually pay what it actually costs for this person. And we're in the red on this one too. You don't have to put up with that. And we have many, many mechanisms, and we've done it literally hundreds of times, where you can empower the kids in such a way that they will pay the patient pay amount, they will pay the amount that is owed to the facility, and they can pay the taxes. And there's ways of doing these things so that the house doesn't go back for taxes, and you guys aren't subsidizing the house on the lake. Let's not do that.
All right, I think that's all the questions that we have.
We're going to give you a minute. A minute. Ask any other questions that you may have.
It'd be great if everyone who's on, still on, could answer the poll as well. It's always helpful for us to get your feedback.
Yeah, and we appreciate you attending. Hopefully you found some information, and we are always here. If you have any family who has a need for Medicaid, it's always a free visit. You can actually 2 free. So you would first talk to one of our paralegals, and we would just get some background information, and it's free of cost, as well as a meeting with David to determine, how we would be able to help them. So they really lose nothing by making an appointment with us, talking to us, and we look forward to meeting with those residents or potential residents that that have a need for Medicaid.
Now, Sara has to be very busy during the day, processing the cases, helping the other members of the Medicaid team. So if you ask her, she will very, very willing to give you her personal cell phone number. I find between 1 and 3 o'clock in the morning is typically the best. So if you wake up at night just wondering how do we handle that case, call Sara. She'll be eager to give you an answer. 1 to 3 a.m.
Whether it makes sense or not, I don't know. But
We're here to help.
I also want everyone to know that if anybody needs our guide to Medicaid planning, I'd be happy to send those out to you, or drop them off in the Grand Rapids, Holland, Shores area. And they're just a great resource with basic information about Medicaid planning. I've gotten quite a bit of positive feedback from the business office managers that it's just a great guide to give families when they first come in and their head is spinning with the possibility of admitting their loved one to the nursing home, finding out what the monthly cost is, and how are they going to pay. So it's just a great guide with still with the 2021 Medicaid numbers from Michigan. So if anybody needs those, just let me know.
We're not saying anything that you don't know better than we do, because you see it more often than we do, probably, that kids get one impression about how things are supposed to work from family members, from friends, the lawyer at church, lots of ideas, misconceptions about how this stuff works. They may be reluctant, and this has happened many, many times. They're kind of reluctant to believe what you tell them. I'm not saying we have more credibility, but sometimes we have more credibility. And lots of times it just takes a little come to Jesus, if you look, pardon the expression, with the kids to get back on the straight and narrow in terms of the patient pay amount and what have you. So, in terms of actually paying, when they hear from us, hey, not only can the nursing home go after the house, and now you're going to have X 100,000 of cash, which is not exempt from Medicaid, which is going to go to the private pay rate at the nurse. That gets their attention. And when they're not paying and there is no other assets, when we explain now, because you spent the money, the facility can come against your house. Again, it tends to focus the mind a little bit. And like I say, we've had, we have a little credibility when we're the ones saying that. Maybe I'm just saying, if you would like our assistance there, we really have two goals here. The first is our clients don't go broke, and the second is the facility gets paid. And you're not our clients usually. I mean, we've had nurse homes hire us to do some of this stuff, but our commitment is to make sure that you, the people who have borne the brunt of it in very, very difficult times, and we understand the financial precariousness of the long-term care system, probably anybody. And our real focus, our dedication is to getting you guys paid. We don't want our clients to do it except through Medicaid, but to get you paid, that's a big deal for us. Screw the kids. Look at our slogans here. Let's get it done. Let's get it done right. That's our commitment to you. That is our commitment. And we don't pull any punches when we're explaining to a family just what our priorities are. Patient first, facility second, the kids third.
Well, I want to thank everyone for joining us today. And our next Medicaid Bootcamp is going to be David answering the most frequently asked questions. So if you can send your top 3 to me, I'll compile those. And email is kcleary@davidcarrierlaw.com. And we look forward to seeing you at the next bootcamp. Again, as Sara mentioned, we'll get that information to you, and this has been recorded and it will be on our website in a couple days. So again, thank you all for coming today.
Thank you.